Welcome to this tutorial. In my previous lecture, I did a video on lease liability and lease assets and what are the components of the lease liability and the lease assets. In this particular video, I will be doing a simple example on how to recognize the lease liability and the lease assets in your books of accounts. This is a lease agreement between Nawa Homes and ABC Co. Let me assume that you are the accountant of ABC Co. and you have been given this agreement to recognize this in the books of accounts. How are you going to treat this transaction? So what are those things that you will be looking for in the lease agreements? So this is the property located at number 5 Plantain Island. And this is the lease term. The lease shall begin on 1 February 2024 and ends on 31 January 2028. So how many years do we have here? From 1 February to 31 January 2028, that is 4 years. But can we say this 4 years is the lease term? We cannot say the 4 years is the lease term right now. We have to look at other components, the extension option and also the termination option. So let me scroll down. Tenant agrees to pay the amount of 200,000 naira for 2 years. So the tenant is paying 200,000 naira for 2 years. Payable in advance, annual renter is 100,000 naira. Okay, so this is the annual renter, 100,000 naira. But the company is making this payment in advance. So take note of this, payable in advance. Security deposits. Tenant agrees to pay 50,000 naira upon signing these agreements. The security deposits will be held for the term of the lease and may be used for repair beyond normal wear and tear, unpaid rents, or cleaning. The deposits minus any applicable deduction will be returned within 20 days after the tenant vacates the premises. So there are two types of security deposits. The first is the non-refundable, while the second is the refundable. So if it's not refundable, that means you cannot claim it back. So you add it to the rights of use assets. But if it is refundable, you will not treat it as part of the lease assets. Instead, you will treat it in accordance with IFRS 9. IFRS 9, financial instruments. Let's look at the other fees. Legal fee and agency fee shall be 10,500 naira and 3,500 naira respectively. The use of the premise, let's leave all of this. Let's go down to, okay, things that are necessary for the calculation. Termination. This lease may be terminated by either party after the first 2 years within 10 days, with 10 days notice. Early termination by the tenant will result in forfeiture of the security deposits. Okay. So if the security deposit is forfeited, it's going to be treated differently. Okay. But now, what are those indications that we a company will look at to say, okay, whether this lease will be terminated or whether it will be extended. Initially, I said the lease agreement now is for 4 years with an extension option and also a termination option. So how do I determine the lease term? You can go back and watch my previous video or check me on LinkedIn. I have a post on that. I'm going to share the link with you in the comment section. So let me go back and I want you to determine the lease term. Okay. So this is the question. I want you to determine the lease term. Let me see if you can determine the lease term correctly. So, but let me do a summary for you here that will help you with the determination. In the agreement, we have 4 years. And also, we were told that the lease can be terminated after 2 years by either party, the determination option. Then also, we are also told that the company can extend the lease for another 5 years. So there are indications, as we said earlier on, there are indications, things that you will look at to say, okay, this lease may be terminated or may be extended. So let me start with the extension option. The first thing you want to look at is the location of this particular asset. Is it in a strategic place? How will it affect the company's business if this lease is terminated after this 4 years period, if the extension option is not taken into consideration? The second thing you want to be looking at is the extension period, the rent during the extension period. Is it lower than what you should have paid? If it is lower, then you want to exercise that option. You also be looking at the assets. Is the asset a customized asset? You want to look at if you have actually improved the asset, or if you will be improving the assets, maybe customizing the assets yourself or doing some work on the assets. And also you want to be looking at the amount to sign a new contract. When you look at all of these, you will now decide whether the extension option will be, whether you exercise the extension option. But in this question, I'll make it easy for you. Let's assume that the extension option will not be exercised. So that means this 5 years will not be added. So we are left with the termination option and also the non-cancelable period. So the lease can be terminated after 2 years. But if you look at the question, the company is paying a security deposit of 50,000, which is a little bit significant. And as such, the company may not want to terminate this lease agreement. If not, they are going to forfeit this security deposit. So the lease term under this example will be 2 years, which is a non-cancelable period, plus 2 years, which is the extension period. So the lease term will be 4 years based on these arrangements. But if the extension option was exercised, the lease term would have been 2 years, non-cancelable period, 2 years termination, plus 5 years extension period. Okay. This is a lease model that's you're going to be using to calculate the lease liability and the lease assets. But for this tutorial, I'm not going to be using the lease model so that you can understand the concepts of the accounting for leasing. If I use the model, it will be easy and you may not understand the basis. So let's look at this sheet here. This is what I'm going to be using. I'm going to be doing it using these formulas. So there are things that you want to take into consideration while calculating the lease liability. The first thing you want to be looking at is the payment dates. Is the payment in advance or arrears? In this question, the payment is made in advance. So that's the very first thing you want to be looking at. Secondly, are the payments made monthly, biannually, or annually? Or what is the interval of the payment? So the second thing you want to look at is what the interval, the payments of each of the payments. In this question, we're told that the payments will be made, the interval is 2 years, every 2 years. But we have only two payments here. So the first payment will be made in advance, second payment also in advance. This is the date from the question. The lease start date is February. Let me expand. Let me zoom this a little bit. Let me zoom it a little bit. Okay. That you can see it clearly. So the lease start date is February 2024. This start date is February 2024, and it's going to end 31 January 2028. So from these dates to this date is a period of 4 years. So if payment is made every 2 years, that means two payments will be made within these 4 years. So it now depends on the points at which each of these payments are made. So in this question, we're told that the first payment will be made on, let's assume on or before, but let's assume it will be made on the 1st of February or before the 1st of February 2024. What I'm trying to do is to get the present value of the liability. Annual lease rental is 100,000 times 4 years, that is 400,000 for this period of 4 years. Out of this 400,000, we are assuming that 200,000 has been paid before the commencement date. So the balance to be paid will now be 200,000 naira. So when will the balance be paid? When you want to discount the cash flow to present value, the first thing you are going to be looking at is when will the payment be made in the future. Will the payment be made next year? Will the payment be made the year after? So when will the payment be made in the future? So based on this example, 1st February 2024 to 1st February 2025 makes 1 year. 1st February 2025 to 1st February 2026 makes the second year. So it means the second payments will be paid within this period, the beginning of this period, as the beginning of 2026. Okay, so from your normal cash flow statement or your investment appraisal, if you remember the rules of investment appraisal, any payment that is made at the beginning of any year is not discounted with that year cash flow, but instead it is taken back to the previous year. So since this payment will be made at the beginning of 2026, I'm going to take it back, 2026. Since this payment will be made at the beginning of 2026, it means I'm going to discount it at the end of 2025. Okay, so the next payments will be made discounted at what, 2025, using this your discounted cash flow model. I'm going to be using two formulas. First of all, this, and secondly, the XMPV formula. So let's see what this will give us here. So the discount factor, how did I calculate the discount factor? I've already calculated it down here. So how did I arrive at this figure? Let me enter the formula again so that you see what is there, how is being calculated. We are assuming 20% incremental rate of borrowing, that the lessee's rate of borrowing, which is ABC co, is 20%. So if I want to discount the cash flows, I'm going to discount it using what? 20%. And your discount factor is 1 plus R, which is 1 plus, now R is the discount factor, which is 20%. I can type 20% or I pick it from here. So 1 plus 20% raised to the power of minus 1. This will be for the first period. Let me close these brackets. So that's how I arrive at that. So if I drag this formula down, I'll be having, this is what I'll be having. So but I want the formula to copy down. So what do I need to do? I need to lock the rates, which is 20%. So I need to lock these rates. That's B2. So put $1 before the B, and $1 after the B to lock the rates. So if I drag it down now, before I drag it down, let me show you what has happened before. See that this cell B is moving. B2 has moved to B3. If I do this, escape. If I do this, which formula is here? It has moved to B4. Okay, but I don't want that to be happening. So that's why I locked the cell. Put $2 before the B, $1 before the B, and another $sign after the B. So let me drag this formula down. So these are the discount rates for each of the given year. So we've established that the first payment will be made before February 2024. So before 2024. So we are assuming your normal cash flow, you call it year 0. That's presently. So the first payment will be made in 2023. So we're assuming ending of 2023. So I'm not going to discount this. I'm going to assume that this is my year 0. Okay, but that's not needed here. So the next payment will be made in 2025, ending of 2025, 200,000. So what is the present value of that amount? Present value of that amount is 138,888. So what does this mean? It means that let me make it a little bit simple. The total amount for the lease is 400. So if I was to pay the whole 400 in advance, I wouldn't have incurred any finance cost on it, any cost of financing it. But now the assumption is that I'm supposed to pay 400, but I decided to pay 200. That means I will still be owing 200,000 naira. So for every year that money remains unpaid, it means I'm going to be paying interest on that amount. Okay, but the present value of that 200,000 is what we just calculated here to be 138. Okay, so now if peradventure, let's assume that this payment was made at the end of 2026, it means that I will have brought the 200,000 naira here. I will have brought the 200,000 naira here and discount it. This will have been the value, right? If it was paid in year 1, this will have been the value. That's what's paid in 2024. This will have been the value. Okay, but it's paid at the end of 2025. So this is the value of the present value of the amount. So said for the lease liability, the present value is what you want to calculate, and that present value becomes the lease liability. Any interest elements will be expensed through the profit or loss. So now what will be the interest element in aggregate? if this is the present value, it means that the lessor has charged interest of how much? 61,000 approximately. So this is the first way you can calculate the lease liability using your formulas. But I can also calculate it using the XMPV formula. So let's see how the XMPV formula works. So this is the beginning, the lease commencement date. So this should be your lease commencement date. So this should be your lease commencement date. February 2024. Which is this? When will the next payment be made? The next payment will be made on the 31 of January 2026. So I'm not bothering myself to say whether it's at the beginning of the year or at the end of the year. I'll just put the next payment date, 31 January 2026. If it was going to be more than one payment, I would have brought, let's assume that there's another payment that will be made on this particular date, right? So I would have just brought it in here. And I'll know that I have 3 payments. Okay. So the beauty of the XMPV formula is that this date interval doesn't necessarily need to be even. I can put 2024 here, 2027 here, 2029 here. The formula will calculate the present value for you based on whatever date you have plugged in. Okay. So, but let me take this out. I just have only one payment after the lease commencement date, which is this. But if I have more than 2, I will bring in the second one. All right. So let's look at the XMPV formula. So I'm using this formula bar here. So you come to formula, there are times that I'm using formula that I may not be able to remember the formula again. So I'll just come to the formula bar here to come and search for that formula. So formula, under your ribbon here, you have financials, then search for X, just type it on your system, XNPV, and search for it, go. That's brought the formula. So I just need to click OK. So this is the formula. So the first parameter there is the rate. I may decide to type in 20%, or since I have it here, I just click on the rate. That's all. Click on the next box, value. What are the values? The amounts. So let me take this here so that you can see what I'm doing. So the value is the amount. So I have 2024 and 2026, 2 period there. Let me re-enter this value. Didn't capture well. So value 2024 to 2026. So the next thing is what? The dates. So enter the dates, these 2 dates also. If I enter it to give me an error, it's giving me value. So there must be something here. So on this date, I'm not paying anything. On these dates, that's when I'm going to pay the final balance of 200,000 in advance against 2027 and 2028. So this is my present value, which gives me the same figure as this. So here, all you just need to know is just to know the dates that those payments will be made. But the lease commencement date will be the first date. Then the next payment dates, whatever the payment dates are. So if you have up to 3 payment dates, you will extend this your formula. Okay, so let me explain this formula without without the box. So this is the formula. This is what I have. So if I want to enter the formula without using that box, let me enter it. So the thing is showing that XMPV. Okay, let me take this out so that you will see it clearly. Now I want to enter the formula again. So equal XNPV. Then I put this. So it has shown me the first parameter should be what? My rate. And I know that the rate is what? 20%. So I put a comma. The next parameter is what? Value. So what are the values? This and this. I put a comma. The next and the last parameter is what? The date. So I have only two dates here, which is this and this. Close your brackets, enter. That's all. So having known the present value of the lease liability, I told you that it shows that there's an interest element of 61,000 naira here. So this interest element, how will it be? How are we going to account for it? You use this amortization schedule. What is the opening value of the lease? That's the present value of the lease. Opening value is what? 138,000. So I will explain this formula also. If I drop it here, it's showing me value because I copied the formula. I need to do case value, just only value. Okay, 1, 2, 3. So this is it. If I have this amount as a present value today, and if you don't make any payment in 2028, based on the interest rates that we are looking at, so the interest rate is still 20%. Look at it up here. So 20% on your opening balance, okay? But remember that the payments will be made when, so based on what we have here, so based on our schedule, we know that the payment will be made at the end of 2025. So 200,000 will be made at the end of 2025. 200,000. That gives me 0. But if I decide to bring the 200,000 here, 200,000 to 2026, you can see that I'm not having a zero balance in the sense that I'm paying interest, 3 interests instead of 2. So I paid interest for this year, but I'm supposed to pay just what? 2 interests because this amount is paid at the beginning of 2026. So I shouldn't pay interest for 2026 because the amount was paid at the beginning of the year. Okay, so let me take it back. So now we know what the lease liability is and we know what the interest for the lease liability also are. At the end of this lecture, let me test your understanding to see if you'll be able to get the accounting entry for all of these transactions. So now back to the right of use assets. But before I go to the right of use assets, I'll just show you how this will work in the lease liability table, this model. So I've calculated the present value of the transaction to be 138. So this is the annual lease rental, 100. 400 is the total lease rental. 200 is the advance payment that was made. Let me increase this a little. 200 is the advance payment that was made. So total lease liability is 200,000. That's 400 minus 200. But what is the present value of that 200,000? Is it 138,000 is the present value. So now, when will that payment be made? The payment will be made at either the beginning of 2026 or at the end of 2025. So this is my schedule. Okay. So that payment will be made any of these dates. But before I look at the payments, I want to look at my opening lease liability, which is what? Which is this. This is the opening lease liability, 138. So this table makes it simple for you to know when to bring in your next payments. For this 2024, there's no payments here. So I moved to 2025. So it has shown me that my closing balance for 2025 is what? 200,000. That means the lease liability should not extend to what? 2026. So I'll just bring in my repayments here. It has means that the payment will be made at the end of 2025, 200,000 naira. So my lease liability becomes what? Closing balance for 2025 becomes what? 0. So this is what was there before, 200,000. But now that I've paid, it becomes what? 0. So this is the way you can use this model to calculate your lease liability. If you have more than one lease, you can't be doing amortization schedule always. Like maybe the banks, or you are working in a company where they have branches all over the country, and they have maybe a company that has up to 50, 60 branches, and you want to do a lease schedule for the rentals. You can't be doing the amortization schedule. You will need a lease model to help you track the liability and the assets. So let me come to the right of use assets. From previous video, can you tell me the components of the right of use assets? Let me go back here so that I don't give you expo. So what are the components of the right of use assets? Let me give you 1 minute and assume that you will get it. Okay, I suppose you got it, but if you didn't, just relax. So based on this question, because the scenario may be different, so there are other components that could be in a lease arrangement that is not here. But so long as it has to do with direct costs for that lease, you need to bring it into the calculation of the right of use. So your lease liability, if you can remember from previous lecture, we said is your right of use assets is the present value of the lease liability plus any payment that was made before the commencement date. So let me just be highlighting this. So lease liability, present value of lease liability plus payments made before the commencement date. Okay, because it's the payment I made before the commencement date is part of my assets. Okay. Plus any direct costs for this rental, we are looking at agency fee, security deposit, legal fee, which are the common ones. Let me make this capital letter ROU, right of use. Okay. So this sheet is linked to the liability sheet. So the present value has appeared here on its own. It's automatic. The prepayment has also appeared here. So the total is 338,888. Now remember that we have refundable security deposit of 550,000. So will this be added to this schedule here? Yes or no? Yes or no? Okay. It will not be added to the schedule because for the refundable deposits, the company is going to get the money back. So the money is not going to be expensed. If it is not refundable, you add it to the value of the lease assets. So this will not be added. The second one is the agency fee. So this is one of the direct costs for this lease arrangement. So we'll add the agency fee of 3,005. Legal fee should be 10,005 from the question, 10,500. So we are going to add the legal fee of 10,500. The total becomes 352,888.89. Now remember that your annual depreciation is, you are looking at two things: the useful life of the assets or the lease term. So the shorter of these two, in this question, we're going to give him the useful life of the asset, but rather we're giving the lease term, which is 4 years. So annual depreciation will be the right of use asset divided by 4, which is this amount here divided by 4. So this is the right of use asset. This is linked to this particular table. So this is my lease template. So everything here is linked to that table. So at the end of the day, it's just for me to key in the date here and the costs. And it's going to calculate, it's going to do the calculation of the depreciation for me. And also at the end of the period, we see my total assets and liability at the end of the period. So at the end of the period, I can just see the book value of my assets at a glance using this schedule and the accumulated depreciation for all of my assets. So let me go back. Now I want you to give me the accounting entry. Now look at your lease assets. The lease assets is 352,888. While your lease liability, the present value of your lease liability is 138,888. So what will be the accounting entry? Now the lease asset and the lease liability, they are different. So what will be the accounting entry for this transaction? Let me give you 2 minutes to decide on the accounting entry, the debits and the credits. So for the lease assets and the lease liability, let me see how you're going to do that. Okay, let me assume that you've gotten it. So let's start with the lease assets. Lease, or let me just make it short form, right of use. Okay, so I have debits. I also have credits. So the lease assets, what will be the lease assets? Easy. These assets has been calculated to be this. So debits, all assets are to be what? Debited. So to increase an asset, to debit the assets. Now, the liability. So lease liability. Is it going to be a debit or a credit entry? Okay, it's going to be a credit entry. All liability normally have credit balances. So we have credits of 138. So what is left? My account is not balanced. Is that correct? Account is not balancing. So how do I balance the account? Okay. So now you now have to look at all of these: prepayment, agency fee, security deposit, legal fee. So these are the things that are not making your account to balance. Is that correct? So if I add all of these together, prepayment, agency fee, that gives me 214. I look at it down here, 214,000. So let me bring in 214,123. Let me bring it in here. So add the two and see if it will balance. That gives me 352,889. So now this is a credit of 214. So what will be the second leg there? Bang. So my account is balanced now. So all these ones, you pay them instantly, so they are not part of your liabilities. Let me take it again. So what you are doing here, I aggregated this sum, which is 200, 35, and 10.5. I aggregated it to arrive at 214. So the entry will have been for the prepayments, you debit the right of use assets with 200, agency fee, debit right of use assets with 200, then legal fee, debit right of use asset with 10.5. Then you now credit your bank with the second leg for each of those transactions. I hope I hope you've learned something from this video. If you have learned something, I would like you to share the video, comment on the video. Also, if you have any question, you can send me a message. You can inbox me on my LinkedIn page, or you can drop a message in the comments section. Thank you.